We're live, right?
I don't know.
No? We're good. Hey guys, how you doing? My first Facebook Live, our first Facebook Live, right? Thanks for joining us today. I'm going to talk to you guys about the property market, give you an opportunity to ask any questions you want regarding property market, the money market, lending, interest rates, property investing, and general commentary and questions with regards to where the market's heading. The question I constantly get asked by all our clients is, where is the market heading? Now, depending on your viewpoint here and obviously what state you live in. First of all, let me give you some background and let me give you an overview. When I talk about the property market in Australia, I'm really talking about the Melbourne and the Sydney markets. And based on my experience, I've been investing in real estate now for close to 20 years. I think I bought my first property back in 1999 or something like that. Little 1.5 bedroom apartment in Fitzroy Street, St Kilda here in Melbourne. And the half a bedroom was because it didn't have any windows. So funny thing is, I had my lawyer, my accountant, pretty much everyone around me telling me not to buy an apartment, especially on Fitzroy Street, St Kilda, where, it's a busy street and there's a lot of thoroughfare there. And it was a ground floor apartment, one of many, just really, a building full of boxes, you could say, with a tanning salon out the front. If you drive past there now, you'll see a tanning salon out the front. And funny thing is, I tripled my money in 10 years. With an investment such as that. So that was my first foray, my first experience into the investment market. Had no idea what I was doing, by the way. I had a couple of guys knock on my door, and my dad had to actually be there with us. He just wanted to make sure nobody was doing the wrong thing by his boy, and it was a fantastic investment. But when I talk about the property market here, I'm really talking about the Australian property market. I'm really talking about the Melbourne and the Sydney markets. If you're looking to make money in real estate, and again, not to offend any other states in Australia, you're not going to make money in any other market other than the Melbourne and Sydney markets, okay? And there's a reason for that. There's certain factors that drive the property markets, and they're the most prominent in Melbourne and Sydney. So, I've got property in other states, and I can tell you from my own experience, if I look at Queensland as a market and Brisbane as a market, my worst performing property in Melbourne is better than my best performing property in Queensland. So, for reasons that I'll get into later on, if you're looking to make money in real estate, focus on Melbourne and Sydney, okay? The other states, I tend to see areas like, cities like Brisbane and Perth, in my opinion and my experience, as more lifestyle opportunities. They haven't had the track record of performing consistently over a long period of time the way Melbourne and Sydney does. And the key driver of real estate is population and employment at a macro level. You need to make sure you've got those factors in play. And that's going to determine how your market, how your property performs in those states. Sheree, can I get a beautiful? So we'll start getting questions soon. Another topic of discussion that I usually get is interest rates. I have a very different view to interest rates than most investors. As an investor myself, and all my staff here are investors as well. Interest rates is probably the last thing we take into consideration when looking at finance. It's not to say that it's not important. It is, but if you're building wealth and you want to take a long-term view, the most important thing to you is to make sure you put yourself in a position where you can continually invest. You can continue to invest, in the next 2, 3, 5, 10, 15, 20 years. And some banks can be very sneaky. They'll dangle the carrot of the interest rate in front of you because that's what gets attention, and that's what will get your attention. But if you have a look at their terms and conditions and their ability to, with regards to offset accounts and the way that their lending criteria, and I'm going to talk about the lending criteria in a minute, It may get you a very hot interest rate up front, but it may hamstring you later on with your ability to continue to invest. And there's no point having a fantastic interest rate if you can, if you're limited with regards to what you can do from an investment perspective. So when looking at finance, make sure you're taking into account more than just an interest rate, okay? There's some amazing products and services at the moment that the banks are offering, and they're not just from the big 4 or 5 banks. One of the things we do as investors, we go straight to the big 5 banks because they make us feel comfortable. They've got a well-established brand in the marketplace, and rightly so. But we discount or don't take into consideration a lot of the other lenders out there. I mean, I've got a mortgage home loans business here at Wealth for Life, and we've got access to something like 60, 65 lenders. And some of the lenders that you may not necessarily have heard of offer amazing products and services. So make sure you shop around and make sure that you actually take everything into account than just an interest rate. That's the common mistake that I find a lot of investors make. They go for the great rate, and 2 years later, when they've built up equity in their portfolio, we either have to refinance them out and put them to another lender, but they're taking a very, very short-term view. And investing, by the way, guys, what I'm going to talk to you about today is purely based on my own experience, okay? It's not what I've read, it's not what others are saying. I'm only going to give you the world through my eyes. The mistakes I've made, what I've learned, and the experiences I've had with me personally, my staff as investors and our clients, okay? So if I don't talk about it today, or if I can't comment about it or won't give a comment about it, it's because it's not my experience, okay? So do you need to take my advice? Of course not. I'm only giving you my own experience here. But, it's you really got to take a long-term view when investing in real estate, okay? I don't know of anybody, unless you're a property developer or a builder and you're quite aggressive and quite big in the marketplace. For a majority of Australians, you need to take a long-term view to build wealth in real estate, okay? And anyone that tells you otherwise either knows something I don't, or is probably misleading you. All right. So now, property prices. Where do I think property prices are going? Whilst I don't have a crystal ball, and whilst there's a lot of negativity in the press these days about property prices. Understand something when you're paying attention to the media, okay? If you have a look at the media, you pick up the papers on a weekend and listen to the news and watch the news, they usually talk about a 12-month window, okay? They talk about what the market's done in the last 3 months, or in the last month, or this financial year, or what it's going to do in the next 12 months, okay? Very few news outlets actually tell you anything beyond or beyond 12 months. Again, you're taking a very, very short-term view. I look at the property market, and I've studied the market quite extensively in terms of what the market has done going back to 1960, things that have affected the market all the way from 1960. I wasn't alive then, by the way, okay? But just the drivers of the property market, and what we find here at Wealth for Life is that when we select and advise on property, there's certain characteristics and certain principles and factors that need to be in play. And when you look at the real estate market and property that outperforms the rest of the market, they all have the same characteristics and the same quality. So if you have a look at something that that gives you consistent growth of, say, 9% year in, year out, it performs differently than some of the properties that where you may get, say, 5% growth, right? And whilst location is important, there's other factors that you need to take into consideration. Having a look at what the property market's going to do over the next 12 months is really irrelevant, because if you're taking a long-term view, you really don't care what it's going to do in the next 12 months. You kind of don't even care what it's going to do in the next 2 to 3 years. Whilst you need to plan for it, and you certainly need to know what you're going to be doing over the next 12 months. Take a long-term view, and if you're selecting good property, outstanding property for that matter of fact, you'll be fine. if you take a long-term view. But if you're trying to get in and out of the market in 12 months, you're effectively becoming a speculator. And I'll tell you right now, I don't know how to predict the top of the market, nor do I know how to predict the bottom of the market. So, we do see a lot of investors that actually try and get in and make a quick buck in 12 months, right? Even if you're doing this 24/7 full time, I don't know anyone that can predict when you reach the top of the market. And by the time you've worked out you are at the top of the market, it's probably too late, right? So you've got to be really careful with trying to get in and trying to get out of the property market over a short period of time. Let's take some questions here. Will the Royal Banking Commission have an impact on the market? Absolutely. So the Royal Banking Commission's come in over the last 6 months and really cleaned up the lending practices of most of the lenders. Now, I, for one, am a big fan of the Royal Banking Commission. Okay, I certainly understand and appreciate that we want good lending practices in place. And whilst a lot of us give the banks a hard time, I love the banks with regards to the fact that they've got an amazing rating. We're not going to, they're not going to put us in a position that you have a look at US markets of, I think, 10 years ago, actually, we had the global financial crisis in America. That's never going to happen in Australia because of the bank's lending practices. So the Royal Banking Commission is essentially, to summarise it, has come in, gotten rid of some questionable lending practices from the banks, more so some internal stuff with regards to what banks and some of their employees and executives are doing internally, and some of the products and services they were actually promoting weren't in the best interests of their clients. So they've cleaned up their practices. Banks have now come out, and their lending criteria as a result is a little bit more detailed, let's say. Okay, so as an investor or as a first homeowner wanting to get into the market, you really need to have a really good understanding of your finances. Okay, know where your money's going, know where you're getting your money from, but know how it's leaving your account. Okay, because banks right now, they used to have a policy where they take your income and take a percentage of that and use that towards your living expenses. Now that's gone. Banks right now are going in, taking your statements, your savings account, and they're looking at every line item, right? To look at any big ticket items that may not be accounted for on a application form, but they're looking for any irregular activity. Okay, so activity that's not common month in, month out, and they'll question it. I mean, we've had them question like a $90 gym membership per month, right? So, banks want to know where your money's going. They want to make sure that you're in a position where you can lend, where you can get a loan, and where you can, invest. Banks don't want to stop you from investing, and banks want to lend you money. They just want to make sure it's not going to come back and bite them in the backside, okay? Nor is it going to bite you in the backside. So, pay attention to your finances. One of the things we talk to our clients about in our education seminars is you need to understand money. You need to know what money's coming in and what money's coming out, okay? If not, it's probably a mistake to get into the property market, all right? So that's my take on the Banking Royal Commission. I think it's a good thing. It cleans up lending practices out there, gets rid of some questionable lending practices internally, and also, people out there in the field as well. Next question. There seems to be a lot of negativity in the media at the moment regarding decline in the property market. What's my opinion on that? I think I've answered that. I see over the next 3 years amazing opportunities in the property market, okay? Right now, we're able to negotiate some amazing terms and conditions and prices for our clients. And understand something, right? Like, the property market over the last 5 years has done extremely well in Melbourne, okay? Where people have experienced some amazing capital growth, right? There's some parts of Melbourne that over 2 years have done 53% growth, right? So if you're expecting that to continue, that's, something like that's not sustainable. The property market doesn't behave like that. Never has, by the way, over a long period of time. So if you're sitting back and you go from, 28% growth per annum, and you drop all of a sudden to 8% growth per annum, don't be disappointed. Okay, it's more a correction than a drop in property prices. Okay, so but there's been a cooling off in the property market over the last 4 months. One based on what the banks have done, and they've tightened up their criteria. more so for investors, and you know, a lot of people coming in from overseas now. The buys from internationally have slowed down. Again, they've had some restrictions put on their lending criteria and getting money out of certain countries. So it's cooled the market off a little bit. Just have a look at auction clearance rates in some parts, in Melbourne and Sydney. Some weeks they've sat as low as 40%. The way I look at that is that's an amazing opportunity for an investor to go in and buy, okay? You don't have as much competition for real estate right now in some markets as you would have. And you know, over the last few weeks alone, we've been able to negotiate some amazing terms and conditions and prices for our clients. So take advantage of the opportunities ahead. I don't see the market dropping by this so-called, you know, 20% that economists and media commentary tend to make out, because if you understand the economy as a whole, it's almost impossible for our markets to drop by 20%, because that has a huge effect on our economy and our country, all right? Negative gearing or positive gearing, Anthony? Thanks, Marty. Listen, when we look at property investing, positive gearing, negative gearing, it's a sideshow. Okay, that's not the criteria we use. First thing I look at when I'm investing in property is I want very good capital growth. Okay, if you're going to build wealth in real estate, you need two things. You need very good capital appreciation, and you need good cash flow. Okay, we select properties that outperform the rest of the market based on capital growth. Okay, don't get just don't get distracted by making an extra $40 a week cash flow on a property. If you're looking to replace an income of $150,000 a year, do the maths and see how many $40 a week investment properties you would actually need to replace an income such as that. Okay, cash flow is important. You don't want to be going backwards on your property, but you need to take into account other things as well. And I've made all my money in real estate from capital appreciation. So of the 80% of Australians who've built wealth using real estate, capital growth is the #1 key factor. Now, with regards to negative gearing or positive gearing, there are ways to handle that. There are ways to handle the losses on an investment property and the tax treatment around that. But the criteria you really should be looking at if you're looking to build wealth is capital growth. All right. I'm getting a lot of money bags here. Good. I like that. There are many people out there that believe only the rich can invest in property. What do you say about that? Well, listen, here's the thing. Have a look at some of our case studies. If you get an opportunity to go into our YouTube channel and Facebook page, have a look at some of our case studies. We've had people on incomes anywhere from $70,000 a year income to like $300,000 to $400,000 a year incomes. Okay. Whilst the more income you earn from work, or the more income you get full stop, will assist you, especially with banks having such a key emphasis on serviceability at the moment. There are many ways to get into the market. Like, I can think of one particular client right now who their household income is about $110,000 a year, and they're on their 10th investment property. Okay. So whilst income is very, very important, I don't think you need to be super wealthy to invest in property. Okay, you just need to have a very good understanding of your money. Money management is very, very important when it comes to this, because giving somebody too much money from real estate could actually get them into a bigger hole if they don't understand how to manage their money from the start. Okay, so it is important to just have a look at what your money's doing. Okay, it's not how much money you earn; it's what you do with your money. But to answer that question, no, you don't need to be wealthy to get into the market. Okay. Hey, good morning, Lee. Mark, good morning. Yeah. Okay. Good. Yeah. Interest rates. Again, I keep getting some questions regarding interest rates. Listen, for those of you that want to know, my take on interest rates is that they're probably going to go up a little bit over the next few years. I don't see them going up any more than 6%, only because of what that will do to the rest of the economy. interest rates are important to investors and homeowners, but also businesses need to borrow money to stimulate growth. Banks need to lend money out. So there's a lot of things that get taken into account. Unemployment rates. Traditionally speaking, you've had interest rates sit at an average of 7% over a long period of time. I don't see interest rates going up any higher than 6%. Okay, I think the variable rate right now is around 5.3%, and you can even get some fixed rates, interest only, as little as I think 4.9%. So you're making a decision based on interest rates. Factor in interest rates sitting at 6%. Okay, make investment decisions based on interest rates sitting at around 6%. How much money do we need to start? Listen, that's a very good question. With serviceability being such a key criteria right now from a lender's perspective, you'd need a healthy deposit to get into the market. And it's an interesting question because, you look at it and say, well, what's the average? The median price in Melbourne right now is I think $882,000, something like that, right? As of this month. So if you look at that, $882,000, 10% deposit's 80 grand, 20% 160 grand, right? You factor in stamp duty, so you're looking at fronting up of $200,000 in equity or cash just to get in and buy a median house in Melbourne. Okay. Difficult for a lot of people. So you need to have a look at actually how you get into the market. And one of the things we're doing with our clients right now is looking at alternative ways of getting into the market. Now, whether that be coming up with your own deposit. Traditionally speaking, I find that us as Australians don't do a very good job of saving money. So coming up with a cash deposit is difficult for a lot of Australians in general. Using equity in a home or a parent's home is one way to do it. But to answer that question, you're probably looking at, anywhere from $60,000, I would say, to $200,000, depending on where your entry point is into the market that you'd need to have to get going. Is Victoria still going to be the leader in the property market? Good question. Victoria and Sydney more so, but I really like Victoria, one, because I live here. But no, seriously, have a look at, again, the factors that I mentioned earlier on, population and employment. And I know in Victoria alone, we're predicting that we're going to have 33 million people in the next 8 years. There's roughly about 1,500 people a week migrating into Victoria, all right? That's net migration. Think about that for a minute, right? That's a lot of people. And when our government, I think earlier on this year in the budget, put aside $8 billion for infrastructure spending, I think one of the things Victoria's done very, very well in relation to the rest of the states, we've got our infrastructure right, okay? So I'd certainly predict Victoria to be the leader in the housing market moving forward. I mean, you can still get in for $880,000 median price. Look at Sydney's median price, I think it's about 1.12 million. So yeah, Victoria's a good place to be moving forward. Is it better to buy an investment property first and later buy your own home after some growth? Good question. Listen, that comes down to the individual, okay? Again, I'll give you my experience here. I bought a number of investment properties myself before I bought my own home, okay? It's the thing you have in this country is that for a lot of people, once they've bought their own home, most people stop. Because we all want to get that great Australian dream of buying our own home, and that's the goal for a lot of people, right? Which is great, which is fantastic. But the problem we find after that is people kind of get complacent and lazy. We've got our home, we've got a good job, we're continuing to work, we're young, life is good. But they're not really looking at the future or what happens when they stop working. And sometimes I find that when people buy their own home, they don't go as aggressive or they don't go as hard as they really need to, okay? Building wealth takes a hell of a lot more time and effort than most people give credit for, okay? To do it properly and to do it where you take a lot of the risks into consideration and you manage those risks, it ain't a short-term thing, okay? There's a lot of planning that needs to go into it. You're not going to build wealth by buying 1 or 2 or 3 investment properties, okay? That's a very short-sighted view. So my advice to anyone looking to do that, invest first, build up some good capital growth, build some good equity in your portfolio, use a portion of that to fund your deposit for your dream home. But the most important thing it does is it keeps you going, keeps you hungry, because you haven't achieved that goal of buying your own home, so you're always chasing it, invest first, get your money to work for you, get a good understanding of money, because buying your own home, it's your deposit you need to come up with. You don't get any tax concessions, and guess what? You're the only person that you're the person that has to pay the mortgage on that. You don't get assistance from tenants or the government or anything else, right? So understand that. But again, more importantly, just look at it from a wealth perspective, building wealth perspective. I found that investors tend to actually get further when it comes to buying their own home, and they're in a much better position anyway, where their mortgage on their own home isn't as big, because they've taken the time to get their money to work for them along the way. Okay, how much time we got, guys? 5 minutes, huh? God, all right. Okay, answered that question. What other topics are making news at the moment? Lending. I keep getting questions regarding lending. Is it easy to get your own? Is it easy to buy your own home as opposed to investing? Listen, there's certainly different lending criteria for first homeowners. Is it easier? No, you still need to be good with your money. You still need to make sure you can demonstrate the ability to service a loan. The government's trying to take the heat out of the property market by cooling investor appetite. And what we've actually found is that appetite for investment property hasn't cooled off whatsoever. Getting finance for investment properties is a little bit trickier if you don't know what you're doing. But still, we're still getting some amazing products and services for our investors. A little bit easier if you want to get your first home. Your loan to value ratios, so the value of the loan compared to the value of the property, what you can borrow against the value of the property is much higher. Interest rates, I think we're seeing interest rates for principal and interest loans as little as 3.6%. That's where you're paying the mortgage down as well as the interest on it. So yeah, there's certainly more attractive incentives. Stamp duty, for under 600,000, there's no stamp duty for a first homeowner, so you get a lot of incentives there. But again, look at what you're doing with regards to your own plan. One of the things we do amazingly well here is we sit down with people and we plan out their next 5, 10, 15, 20 years, okay? So we give them a starting position, what they need to do in between, and then an exit, okay? So part of building wealth is that you are debt-free. And whilst I know we'll have challenges and have our own relationship with debt, you need to get into very good debt. And by good debt, I mean, putting money into things that appreciate in value. You need to get into debt if you want to build wealth. There's no other way around it. Because doing it any other way, it either becomes too slow and you never achieve your goal, or, for a lot of people, the only debt that they usually do have is their own home. That's not going to build your wealth. So I think we're done for 2 more questions. What have we got here? What's the minimum borrowing capacity for a couple to start? Minimum borrowing capacity. Well, again, have a look at the Melbourne market. I think 12 months ago there were 104 suburbs in Melbourne with property prices under 600,000. Today, there's only 68 suburbs in Victoria, I should say, where property is under 600,000. So getting very tough, guys, to get good quality real estate. And I mean good quality real estate under $500,000. Okay, if you look, anything I find anything under $500,000 is compromised in some way. And for a lot of people that get into the market, I'd have a look very closely at what you're buying for $500,000 in a city like Melbourne or a state like Victoria. Okay, we're finding that you can still get very good performing real estate, but you're literally at that $600,000 mark to get in. So for those of you that wanting to build a portfolio and you want to get started and you want to accumulate good quality assets, your starting position in a city like Melbourne, state like Victoria, would be $600,000. Hopefully I've answered that question for you, Mark. What's the optimum deposit? 5, 10, 20%? Yeah, listen, again, depends on your assets and liabilities, depends on your income, and it depends on the bank's lending criteria. Very few banks will give you a 95% lend on an interest-only loan for investment property these days. Whilst there are a few out there, they're becoming more extinct than not. But 10% deposit, 20% deposit is good. But again, it's a balancing act. You've still got to be able to afford the mortgage, and the banks and us will determine what you need to have, just so that you can handle any debt that you get as part of your investment strategy. But I'd be getting ready to have a 10 to 20% deposit if you want to get into the market. All right. I think we're done, guys. Oh, more questions. What are your thoughts on rural Victoria? Again, it doesn't demonstrate the factors that, in my opinion, anyway, it doesn't demonstrate the factors that drive property prices. I'll give you the example. We have a lot of clients in rural Victoria, and I just look at their home and the growth they've had in their home. The limited employment opportunities in those parts of Victoria, and just population too. You need to really understand what your city, where you're investing, what it's doing at a macro and a micro level, okay? Because that'll help you determine where you should be buying property. I still think there's much better opportunities closer in to the CBD, in that 2 to 10 kilometre range before I'd start to go into rural Victoria. But again, my experience only. What do we got, Cherie? We've got a gift voucher for you Facebook followers. How we operate here, we sit down and we do a consultation meeting with clients wanting to get into the property market and build wealth. We normally charge $997 for a meeting such as that, because there is quite a bit of planning that goes into something like that. It's a very extensive meeting. It basically sets out your next 10, 20 years, right, given to you on a map. For today and for this Facebook Live, we're giving away a free voucher to the tune of $997. For any of you then that have seen this live, contact our office on 1300 793 877. Speak to Tracy. Make a time to come in and have a chat to us. Free, no obligation first consultation at our cost. We'd love to be able to sit down with you guys. We love helping people, okay? We love helping people build wealth and get ahead financially. This country is not doing too well with regards to, too many people are just relying on their income from work, okay? And not really looking at what's ahead, okay? And what we see is that too many people realise that their income that they've earned from work isn't enough. Sadly, they realise that when it's too late, okay? And for any of you out there that are wondering, can I get started in the property market, as I'm approaching 55, 60, very, very, very difficult, okay? Too many restrictions put on you as a borrower from the banks, okay? Like I said earlier before, you need to give yourself a decent runway here, okay? The longer runway, the quicker you get into the market, the easier you're going to be able to manage your risk. The later you leave it, the more your risk is going to increase. And for a lot of you, trust me, that won't be something that you guys will want to take on board. So come and have a chat to us. We'd love to sit down and talk to you, talk to one of my boys here, and let's get you started. Thanks, guys.
Don't forget to tune in next time.
And don't forget to tune in next time. I think we're running one of these weekly, fortnightly, 11 a.m.
Tuesdays.
Let us know if 11 a.m. works for you guys.
Every Tuesday.
Every Tuesday. Yeah, let us know if Tuesday works for you guys. We'd love to get your feedback on that. But look forward to speaking to you guys soon. Thanks.